All right, let's dive into something that sounds, well, a little weird. We're going to unpack a strange puzzle in the world of finance, how a really smart, protective business move can end up making a company's books look dangerously volatile.
I mean, it just doesn't seem to make sense, right? You make a clever decision to protect your company, to reduce risk, and then suddenly your earnings reports start looking like they're on a wild roller coaster. So, what on earth is going on here?
Okay, to get our heads around this, picture this. You're a baker. Your whole business, everything depends on wheat. Your biggest nightmare is the price of wheat skyrocketing, because that would just crush your profits. You need a way to lock in a price today for all the wheat you're going to need 6 months from now. It's a classic business problem. How do you manage that price risk? Well, the tool for this job is something called a derivative. Now, it sounds super complex, but really, it's just a contract. For our baker, it could be a simple contract to buy wheat at a fixed price in the future. So if the market price for wheat goes way up, the contract becomes more valuable, and that gain protects the baker from those higher costs. So what actually makes something a derivative in the eyes of an accountant? It really just boils down to three things. One, it settles in the future. Two, it costs very little or even nothing to get into it. And three, its value is directly tied to something else, like the price of our wheat. So our baker used a derivative to lock in the price of wheat. Fantastic. The business is protected from those crazy price swings. Problem solved, right? Well, not so fast. This is where our story takes a sharp turn. Because by solving that business problem, we've accidentally created a completely new one, an accounting problem. And here's the brand new problem. It's all about timing, a total mismatch. See, the actual cost of the wheat, that expense, it won't show up on your books until you actually use it way down the line. But the gain from your protective contract, well, accounting rules say you have to report that immediately. You end up with this huge disconnect. And the result is just pure chaos in your financial reports. In one reporting period, you show this massive, kind of artificial profit from that derivative gain. Then, in the next period, you show a huge loss from the high cost of the wheat. If you're an investor looking at this, it seems like the business is on a completely wild ride, even though, in reality, you've made things perfectly stable. So how in the world do we fix this completely distorted picture? Well, thankfully, the accountants came up with a solution for this very problem. It's an optional set of rules, and it's called hedge accounting. And it's designed to make the financial statements actually reflect what's going on in the business. The whole goal of hedge accounting is incredibly simple: alignment. It lets you sync up the timing. It basically says, hey, let's hold off on reporting that gain from the derivative until the exact same period we report the cost of the thing we were protecting, our wheat. It's all about matching. Now, there are two main flavors of hedges. A fair value hedge is for protecting the value of stuff you already have. But what we're really focused on today is the cash flow hedge. This one's for protecting against risks to future cash flows, like our future purchase of wheat. And notice the really key difference here. The gains and losses don't go straight to profit. They go to this temporary holding area called Other Comprehensive Income, or OCI for short. Okay, theory is great, but let's see how this actually works in the real world. Forget the baker for a second. Let's imagine a company that's expecting to get paid 3 million dinars in the future. Their risk isn't the price of wheat. It's the fear that a bad exchange rate is going to wipe out all their profit. So here's our timeline. On November 1st, they sign a contract to lock in their exchange rate. Then, on December 31st, it's the end of the year. They have to report their financials. That's exactly when our accounting mismatch would normally cause all that trouble. And finally, on January 31st, the whole deal is done. So, by the reporting date, December 31st, let's say their contract has gained $100,000 in value. Now, normally, that would slam right into the profit statement and cause that crazy volatility we talked about. But with hedge accounting, the part of the gain that perfectly offsets the risk, we call that the effective portion of $98,000, it gets parked in that temporary holding pen, the OCI. Think of OCI as a financial waiting room. The big chunk of the gain, that $98,000, it just sits there, patiently waiting to be matched up with the currency transaction later on. Only that tiny $2,000 piece that was ineffective, the part of the hedge that didn't perfectly cancel out the risk, hits the main profit and loss statement right away. And finally, when the company actually gets the dinars, that money that's been sitting in the OCI waiting room gets what we call recycled. It's moved out of OCI and into the main profit and loss statement in the exact same period that the currency loss is recorded. It's a perfect match.
And the result? By the time the deal is all said and done, the derivative has a total gain of $104,000. This gain flows into the profit statement at precisely the right moment to completely cancel out the loss from the bad currency move. The company's income is smooth, it's predictable, and it actually reflects the success of their business strategy.
So why does any of this matter? Because hedge accounting isn't just some boring technical exercise. It's about telling the truth. It gets rid of that misleading volatility, it shows the true economic story of what's happening, and it gives investors a much more faithful picture of a company's performance. It basically turns the financial statements from a distorted funhouse mirror into a clear window. Which really leaves us with one final thought. The next time you see a company report its earnings, especially one in a volatile industry, it's worth asking yourself, are you seeing the real bumps of an unmanaged risk or the smooth result of a well-executed hedge? Are you really, truly seeing the full story?